Hi there, it's Friday the 3rd of April 2020. I'm Steve Towers. Welcome to ITB. Let's get started. In response to the economic crisis caused by COVID-19, many countries continue to announce deferrals of income tax and VAT payments, and several countries announce substantive tax law changes. The OECD has compiled information on the various measures taken so far. The information is in two forms: a database, which is continually updated, and a reference document. Both of these items are available on the COVID-19 page on the OECD website. For the relevant link, please go to our website or app. Let me quickly run through the latest examples of substantive tax law changes impacting companies. In Norway, for the second time during the crisis, the government has cut its lower VAT rate. It was originally cut from 12% to 8%. It's now been further cut to 7%. In Thailand, the withholding tax rate on domestic fee payments has been reduced from 3% to 1.5%, effective the 1st of April, and then to 2% from the 1st of October. In the Czech Republic, the Ministry of Finance has proposed that a tax loss carryback provision be introduced. And as a follow-up to last week's story concerning Russia's dividend withholding tax, it's been reported that the Russian government has notified Cyprus that they wish to negotiate an amendment to the Cyprus-Russia Treaty to allow a 15% dividend withholding tax rate to apply. But Mexico is exceptional. Despite the fact that some tax measures have been introduced at the local level, the President has refused so far to provide any assistance for businesses. And this week, the tax authorities issued a press release which reminds taxpayers to fully comply with their tax obligations. Meanwhile, the European Commission has proposed an extension of the State Aid Temporary Framework, which was adopted on the 19th of March. For a copy of the Commission's press release, please go to our website or app. In India, the Equalization Levy has been significantly expanded by the Finance Act 2020, which has recently become law. The expansion is effective from the 1st of April 2020. Let me give you a quick reminder of the original Equalization Levy, and then I'll tell you about the expansion. The Equalization Levy was enacted in the Finance Act 2016. The rate of levy is 6% to be applied to the consideration received or receivable for any specified service. The term specified service is defined to mean online advertisement, any provision for digital advertising space, or any other facility or service for the purpose of online advertisement, and includes any other service as may be notified by the government in this behalf. The levy is imposed on consideration received or receivable for a specified service by a non-resident person, exco in this example, in two situations. Firstly, from a person resident in India and carrying on a business or profession, or secondly, from another non-resident person, YCO, which has a PE in India. An exception applies if the non-resident recipient itself has a PE in India and the service is effectively connected with that PE. A collection obligation is imposed on the payer of the consideration. India Co. in situation 1 and WICO's PE in situation 2. And finally, income which is subject to the equalization levy is exempt from Indian income tax. The existing operation and scope of the 6% equalization levy in regard to specified services is unchanged by the Finance Act 2020. However, the Act now provides for a 2% equalisation levy on the amount of consideration received or receivable by an e-commerce operator from e-commerce supply or services, provided there is a relevant nexus with India. Let me take you through each of these concepts: e-commerce operator, e-commerce supply or services, and the relevant nexus with India. The term e-commerce operator is defined to mean a non-resident who owns, operates, or manages digital or electronic facility or platform for online sale of goods or online provision of services, or both. The term e-commerce supply or services is defined to mean 1. Online sale of goods owned by the e-commerce operator, or 2. Online provision of services provided by the e-commerce operator, or 3. Online sale of goods or provision of services, or both, facilitated by the e-commerce operator, or 4. Any combination of activities listed in clause 1, 2, or 3. There are 3 situations where there will be a relevant nexus with India. All of the situations are based on the identity of the person to whom the e-commerce supply or services are made or provided or facilitated by the e-commerce operator. I'll call that person the nexus person. The first situation is where the nexus person is resident in India. The second situation is where the nexus person buys such goods or services or both using Internet Protocol address located in India. And the third situation is a little more complex. Firstly, the nexus person must be non-resident. And secondly, these specified circumstances must exist. 1. Sale of advertisement which targets a customer who is resident in India or a customer who accesses the advertisement through Internet Protocol address located in India. And 2. Sale of data collected from a person who is resident in India or from a person who uses Internet Protocol address located in India. There are 3 exceptions to the operation of the 2% equalisation levy. Firstly, where the e-commerce operator has a PE in India and the e-commerce supply or services is effectively connected with that PE. Secondly, where the 6% equalisation levy applies. And thirdly, a de minimis exception where the e-commerce operator's aggregate annual turnover with a relevant nexus with India is less than 2 crore rupees, which is about $260,000 US. Let me make a few additional points in regard to this new 2% equalisation levy. Firstly, it will be levied on a quarterly basis, with the first payment due on the 7th of July 2020. Secondly, the 2% levy is imposed directly on the non-resident e-commerce operator. Thirdly, unlike the 6% levy, the 2% levy is not limited to B2B situations. It equally applies in B2C scenarios. Fourth, like the 6% levy, the consideration to which the 2% levy applies will be exempt from income tax. And finally, also like the 6% levy, the 2% levy is intended by the government to fall outside the scope of India's double tax treaties. And a final point to note is that the Finance Act 2020 includes a provision which deems an Indian source for income tax purposes for several types of outbound payments which are similar to the payments subject to either the 6% or the 2% equalization levy. However, 2 points should be noted. The first is that this provision would be subject to India's double tax treaties if the recipient is resident in a treaty jurisdiction. And secondly, if there's an overlap between this provision and either the 6% or the 2% equalization levy, the equalization levy will apply and the payment will be exempt from income tax. Here is this new provision. Please hit the pause button to study it. For a copy of the Finance Act 2020, please go to our website or app. You might remember that in January this year, 17 members of the WTO agreed to form their own private appeal settlement arrangement in regard to trade disputes. This was in response to the fact that the WTO's appellate body is currently inoperative due to the US vetoing new appointments to the body. Well, the arrangement has now been formalised between 16 WTO members, including the EU. It's now called the Multi-Party Interim Appeal Arbitration Arrangement, and it's in accordance with WTO rules. For a copy of the agreement between the participating members, please go to our website or app. The Platform for Collaboration on Tax, which is a joint initiative between the OECD, the UN, the IMF and the World Bank, has launched its first integrated website. For a copy of the press release on this matter, please go to our website or app. In Australia, the Federal Court has decided another deduction case in regard to the capital versus revenue expenditure issue. This case concerns the payment of so-called capacity charges, which were payable each year on a reducing basis in regard to the acquisition of electricity from a power station. The court held that the capacity charges were capital in nature and thus non-deductible. For a copy of this case, please go to our website or app. In Hong Kong, the tax authorities have issued guidance on the profits tax treatment of the digital economy, electronic commerce, and digital assets. The guidance, of course, relates to the current state of the law. It does not deal with, for example, Pillars 1 and 2. It discusses issues such as carrying on business in Hong Kong, the location of profits, PE status, transfer pricing, income characterization, and cryptocurrency. For a copy of this guidance, please go to our website or app. In India, there have been two interesting cases in regard to cess. As you probably know, cess is a special form of income tax surcharge in India, with the revenue from the cess earmarked for a specific purpose. For example, for education cess, the revenue is earmarked for education purposes. Let me briefly take you through the two cases. The first case is a decision of the Delhi Income Tax Appellate Tribunal. It concerns the relationship between cess and the France-India Treaty. The taxpayer is a French resident company which receives royalties from sources in India. Under domestic law, the royalties are subject to income tax and cess. However, Article 13.2 of the treaty effectively limits the Indian tax to 10% of the gross amount of the royalties. The issue in the case was whether that 10% limitation also covers the cess. In other words, whether the 10% limit applies to the aggregate of income tax and cess. Let me take you through the relevant provisions in the treaty. Firstly, Article 2.1 tells us that the convention applies to Indian income tax, including any surcharge thereon, surtax and wealth tax, and it defines all of those taxes as Indian tax. Secondly, Article 3.1 defines tax to mean Indian tax. And thirdly, Article 13.2 provides for the tax limitation on royalties. Based on a 2015 decision of the Kolkata Income Tax Appellate Tribunal, the tribunal in this case held that cess is a surcharge on income tax, and therefore cess is included in the definitions of Indian tax and tax. And accordingly, the Article 13.2 limitation applies to the aggregate of income tax and cess. For a copy of this case, please go to our website or app. The second Indian case concerning cess is a decision of the Bombay High Court. The issue in the case was whether the payment of cess was an allowable business deduction for a company. The Income Tax Act includes a provision, Section 40A(2), which denies a deduction for any rate or tax levied on the profits or gains of any business. The taxpayer argued cess is not mentioned in that provision, and therefore a deduction for cess is not denied by the legislation. And the court agreed with the taxpayer for several reasons, including, firstly, if Parliament had wanted to deny a deduction for cess, it would have been easy to include a reference to cess in Section 40A(2). Secondly, a version of Section 40A(2) in an earlier Income Tax Act did include cess. Its absence in the current Act appears to be quite deliberate. And thirdly, guidance issued by the tax authorities in 1967 stated that a deduction for cess is not denied under this provision. For a copy of this case, please go to our website or app. And in Japan, legislation for the 2020 tax reform has been passed by Parliament. For a copy of the legislation, please go to our website or app. The European Court of Justice has decided a case in regard to the applicability of the EU Parent Subsidiary Directive to a company incorporated in Gibraltar. The court held that due to the fact that Gibraltar companies and Gibraltar corporation tax are not expressly mentioned in the annex to the directive, then the directive does not apply to dividends paid by a company resident in an EU member state to a Gibraltar company. For a copy of this case, please go to our website or app. In Luxembourg, the government has transmitted to Parliament a bill which would introduce measures against non-cooperative tax jurisdictions based on EU recommendations. You'll remember that Sweden recently released a draft bill on the same topic. The Luxembourg bill would disallow deductions for interest and royalties which are paid or due to related entities located in a jurisdiction on the EU blacklist. Currently, there are 12 such jurisdictions. These new rules are expected to be effective the 1st of January 2021. In the Netherlands, a court has decided a case in regard to the claiming of input tax credits by a bank, which made a mixture of VAT taxable and VAT exempt supplies. The court held that the so-called actual use method could be used by the bank instead of the standard pro rata method based on turnover. For a copy of this case, please go to our website or app. In the UK, the tax authorities have issued guidance on how to calculate a company's digital services tax liability. As you know, the UK DST is effective from the 1st of April 2020, although at the present time the legislation has not been enacted. For a copy of the guidance, please go to our website or app. And also in the UK, the Supreme Court has issued a decision in a VAT test case concerning services performed by Royal Mail. The services were incorrectly treated by both Royal Mail and the taxpayer as VAT exempt, whereas they should have been subject to standard rate VAT. Now, many years later, the taxpayer seeks an input tax credit for the VAT which it should have been charged but was not by Royal Mail. If this sounds familiar, it's because I covered a similar case decided by the High Court in ITB earlier this year. The Supreme Court concluded its decision by referring various questions to the European Court of Justice. For a copy of this decision, please go to our website or app. In South Africa, the tax authorities have issued 2 items of guidance, one on tax depreciation and the other on tax dispute resolution, but not including MAP. You'll remember that I covered South Africa's recent MAP guidance in last week's ITB. For a copy of these latest 2 items of guidance, please go to our website or app. Also in South Africa, the Supreme Court of Appeal has decided a case in regard to the calculation of mineral royalties. The case involves an interesting exercise in statutory interpretation. Under the legislation, the mineral royalties are to be calculated on the gross sales received or accrued by the taxpayer. The legislation then says that for this purpose, the amount of the gross sales is determined without regard to any expenditure incurred in respect of transport, insurance, and handling of the minerals. So, for example, let's assume that the taxpayer receives or accrues $10 million, but it also incurs expenditure of $1 million on transport, insurance, and handling. Is the amount of gross sales $10 million or $9 million? Interestingly, the court held that the correct answer is $9 million. The phrase, without regard to any expenditure, effectively means after deducting that expenditure. And, said the court, that is the correct answer regardless of whether the taxpayer's sales invoices, which it issues to purchasers, separately charge for transport, insurance, and handling. For a copy of this case, please go to our website or app. In Canada, the Supreme Court has decided a case in regard to the income tax treatment of derivative instruments which hedge an underlying capital asset. Not surprisingly, the court held that the derivative instruments would take on the same capital character as the underlying asset. Thus, a loss incurred on the derivative would be a capital loss and not a business loss. For a copy of this case, please go to our website or app. In the US, the Treasury and IRS have issued proposed regulations in regard to insurance companies. For a copy of the proposed regs, please go to our website or app. And also in the US, the IRS has issued 2 further private letter rulings in regard to REITs. Both rulings concern the issue of whether parking revenue qualifies as rents from real property. For a copy of the two rulings, please go to our website or app. And now for this week's treaty developments, and again a very slow week, presumably due to COVID-19. All we've had is one treaty enter into force. I have two articles for you this week. The first article is called Role of the Preamble for the Interpretation of Old and New Tax Treaties and on the Policy of the Prevention of Treaty Abuse. It's written by Luc Debrow and it's published in the Bulletin for International Taxation. The article considers the effect of the preamble of double tax treaties, both before and after the preamble was included in the 2017 OECD Model Treaty, and a similar preamble was included in the MLI. In regard to the before situation, the article reviews a number of court decisions, including La Mesa, Mill Investments, Alta Energy, and Verdunay. And then the article considers the possible effect of the preamble in the 2017 OECD Model Treaty, particularly in regard to the interpretation of the principal purpose test in Article 29. As you probably know, there have been no court decisions so far on this issue. I've set out here the text of the preamble. Please hit the pause button if you'd like to study it. The article concludes in this way. The new preamble is of little to no help in interpreting the language of the PPT. The preamble is also not helpful in assisting to ascertain the objectives underlying the treaty provisions, which the taxpayers' arrangement allegedly abuses. That is, the second prong of the PPT. Only cases of double non-taxation that result from structured tax evasion or avoidance, including treaty shopping, are intended to be caught by the preamble. In the absence of an abusive arrangement, a denial of treaty benefits because there is a double non-taxation would override the clear terms of the treaty and would be in breach of Article 31 of the Vienna Convention. The second article is called Fiscally Transparent Vehicles After Mexico's Tax Reform, U.S. Investment Fund Traps. It's written by Eduardo Brandt and it's published in Tax Notes International. The article provides this introduction. As part of its 2020 tax reform and heavily motivated by the OECD's BEPS initiative, Mexico enacted several rules to avoid base erosion, including some on foreign entity classification that will be effective as of 2020 and 2021. Mexico had no specific provisions before that, instead following the construct of legal personality to determine an entity's classification for tax purposes. The new rules modify the status quo for some vehicles typically used by funds to invest in Mexico and may create additional complexities for them. This article is divided into two overarching sections. The first overviews the new entity classification rules under Mexican domestic law and how they may create difficulties for US funds investing in Mexico. The second discusses the effects of the new rules in the context of the Mexico-US tax treaty as well as several problems caused by potential entity classification mismatches between the United States and Mexico. Well, that's the way it is this Friday, the 3rd of April 2020. The ITB team will be having a well-earned one-week break. We'll be back full of life on Friday, the 17th of April. Until then, I'm Steve Towers. Have a great weekend.